Welcome to our seminar titled How to Beat the High Cost of Obamacare. My name is Borbala Banto, CPA, your host and founder of Concierge CPAs and our division called Better Numbers for Lawyers. As you know, Concierge CPAs is a premier full-service boutique certified public accounting and advising practice, helping law firms and professional service businesses improve their financial performance and get control of their numbers. Currently, we have clients in 17 different states around the U.S. We deliver a powerful combination of turnkey advising and comprehensive tax planning solutions to our clients. Our goal is to become our clients' most trusted business advisors and financial catalysts behind their successes. Make sure to check out our website at BetterNumbersforLawyers.com and sign up for helpful tips for better and more proactive financial performance. Check us out on Facebook at Better Numbers for Lawyers and follow us on Twitter at Borbala Banto CPA. Make sure you subscribe to our YouTube channel, also called Better Numbers for Lawyers. Our presentation is about 1 hour long today. Make sure you jot down any questions and contact us after the presentation. The contact info will be shown at the end. As an added bonus, you will receive our book titled Pocket Guide to Obamacare. Also, as an additional benefit, you will get notified and will receive access to all updates that we are going to put together as the law changes in the next 12 months. So thank you for joining us today. Let's dive in. Back in 2010, President Obama signed the Patient Protection and Affordable Care Act and the companion Healthcare and Education Reconciliation Act of 2010. Together, those two acts, better known by Republicans and Democrats alike as Obamacare, represent the biggest change in how we finance healthcare since Medicare was created in 1965. They also include some of the most significant tax changes in a generation. In 2012, as you all know, the U.S. Supreme Court ruled that the act's controversial individual mandate was a constitutional exercise of the government's power to tax. The court's decision dashed the hopes of those who wanted to see it eliminated the easy way. Republican candidate Mitt Romney made the law a centerpiece of his 2012 presidential campaign, vowing to undo it on his first day in office. And despite his loss, Republicans in the House of Representatives continued to pass votes opposing the law. Healthcare reform has been an intensely political process. Not one single Republican voted for the law in either the House or the Senate. And polls show that Americans are overwhelmingly confused and concerned. They still don't know just what the new law does, and they don't know how much it's going to cost. I'm not here to debate the merits of the bill. It's going to take a long time before historians can make that call. But I can help by explaining some of the most important changes and what they mean for you, your healthcare, and your taxes. Let's start by walking through the law's main provisions. First, we'll talk about what changes when, and we'll talk about the more important changes in more detail. The first changes went into effect pretty much as soon as the law passed. On the tax side, small businesses with up to 25 employees earning $50,000 a year or less qualified for a new tax credit of up to 35% of the cost of providing health benefits to their employees. We'll talk more about that credit shortly. And who can overlook the new 10% excise tax on indoor tanning services that use certain ultraviolet lights? That rule took effect on July 1st, just as outdoor tanning season went into full swing. On the healthcare side, insurance companies cannot deny coverage to children for pre-existing conditions. They cannot set lifetime limits on plan coverage, and they have to let children stay on their parents' plans through age 26. Insurance companies actually stepped up to the plate early on that last rule. They love charging new premium dollars for healthy young adult customers who aren't likely to cost them much anyway. Finally, Medicare Part D recipients who entered the so-called donut hole will get rebates and discounts on prescription drug coverage. As you know, the donut hole is a gap in prescription coverage where the government pays nothing and beneficiaries pay the full cost of drug themselves. Starting in 2011, the penalty tax on health savings account withdrawals not used for healthcare expenses doubled from 10% to 20%. On the healthcare side, Medicare Part D recipients entering the donut hole began qualifying for discounts rather than rebates on their prescription drugs. 2012 wasn't an especially busy year for Obamacare either, if you don't count the attorneys busy challenging or defending it in various courts. On the tax side, starting for the year 2012, employers with 250 or more employees must start reporting the aggregate value of health coverage they provide to their employees on Form W-2. This reporting is for informational purposes only and does not add anything to anyone's taxable income. On the insurance side, special new medical loss ratio limits apply to insurers. Large group health plans, defined by state as 50 plus or 100 plus, must apply at least 85% of all premiums towards claims and quality improvement costs. Otherwise, they must rebate the difference to the policyholders. Smaller plans must apply at least 80% of premiums towards claims and quality improvement. 2013 is a big year for tax changes. Up until now, medical and dental expenses have been deductible if they exceeded 7.5% of your adjusted gross income, or AGI. Unless, of course, you are subject to alternative minimum tax, in which case they have to exceed 10% of your AGI. Starting in 2013, that floor rises to 10% of AGI for everyone. Unless you or your spouse are 65 or older, in which case it stays 7.5% of AGI until 2006. Unless, of course, you are 65 and subject to AMT. Are we all clear here? If you participate in a healthcare flexible spending account at work, your contributions will be capped at $2,500 a year with no contributions for over-the-counter medications. If your earned income is above $200,000 or $250,000 if you file jointly, you will pay an extra 0.9% Medicare tax on earned income above those amounts. Given the new marginal tax rates in the fiscal cliff bill, that extra Medicare tax could help push your actual marginal rate well above 40%. Finally, you will pay a 3.8% unearned income Medicare contribution on investment income if your AGI is above those same thresholds. Investment income is defined as interest, dividends, capital gains, rents, royalties, and annuities. We'll talk a bit later about strategies for avoiding this new tax. This is a big change. It's the first time investment income has ever been subject to Medicare tax. And lots of commentators fear it's just the proverbial tip of the camel's nose under the tent for even higher taxes. After all, it's a lot easier to go from 0 to 3.8% than it is to go from 3.8 to, let's say, 5.8%. So we'll be paying lots of attention to this provision. On the healthcare side, starting in 2013, the new law limits health insurance company deductions for executive compensation to $500,000 per person, as opposed to the regular $1 million for other businesses. That's right, this doesn't actually stop insurance companies from paying their top executives more than $500,000. It just stops them from deducting anything over $500,000 on their own business tax returns. 2014 brings the most controversial changes. Most individuals who are not covered through their employers will have to maintain minimum essential coverage or pay individual penalties. This is the so-called individual mandate you've heard so much about. We'll talk about that more in a bit too. 2014 was the year when it was originally scheduled that employers with more than 50 employees have to offer health benefits or pay a penalty up to $2,000 per employee. If they offer coverage, that does not meet minimum standards, the penalty could jump to $3,000. The Obama administration has since postponed this requirement to 2015. We'll talk about this in more detail in a bit. Finally, 2014 is the year when the biggest insurance changes go into effect. Specifically, insurance companies cannot deny coverage to anyone for pre-existing conditions. Plans cannot set annual limits on coverage. Remember, the ban on lifetime limits took effect in 2010. States can choose or not choose to expand Medicaid eligibility to non-elderly, non-pregnant individuals with incomes up to 138% of the federal poverty level. For 2014 to 16, the federal government will pick up 100% of those costs. The law requires states to establish insurance exchanges or join the federal exchange where individuals and small businesses can comparison shop for coverage. We'll talk about those exchanges in more detail in a bit. Finally, 2018, the law imposes a 40% excise tax on Cadillac plans, costing more than $10,200 per year for singles and $27,500 per year for families. The goal here is simply to rein in costs. And there's evidence to suggest it's already working. Employers have begun cutting back on some of the most generous plans by raising deductibles, copays, prescription, and the like. But this provision doesn't take actual effect until 2018, which some experts think means it won't ever take effect at all. Now let's talk about specific provisions in more detail. We'll start with the new tax credits for small employers, which went into effect all the way back in 2010. To qualify for the credit, you have to pay at least 50% of the employee-only premium amount for your employee's coverage. You cannot have more than 24 full-time equivalent employees or FTEs. Your average wage cannot be more than $50,000 per year. Oh, and you cannot claim the credit for any premium you pay on your own behalf. For tax years 2010 through 2013, the maximum credit is 35% of the amount of premium you pay. The credit goes down if you have more than 10 employees or the average wages are more than $25,000. Starting in 2014, the maximum credit goes up to 50% of the premiums paid. If the credit is more than the business owes, you can carry it back against previous taxes you paid or carry it forward to offset future taxes. This all sounds great, right? The reality is, for 2010, just 170,000 employers across the country claimed any credit at all, and only 28,100 claimed the full credit. The fact is, small employers with low payrolls just cannot afford to buy insurance for their employees, and the credit isn't enough to encourage them to start. Spending $1 on the new benefits to save 35 cents in tax is hardly a winning proposition, especially for struggling small businesses. Now let's talk about the most controversial part of the law, the individual mandate. The law says that by 2014, all Americans have to maintain minimum essential coverage. If not, they face a penalty. That penalty starts at $95 per adult or $47.50 per child, up to a maximum of $285 per family or 1% of income in 2014. It rises to $695 per adult or $347.50 per child, up to a maximum of $2,085 per family or 2.5% of income in 2016. After 2016, those dollar amounts are indexed for inflation. Every year, your insurance company will send you and the IRS a form confirming you have coverage. You'll have to attach that form to your income tax return. That's a pretty big step. The government has never required us to buy commercial products or services before. If you drive a car, most states mandate you buy car insurance, but nobody says you have to buy a car. If you practice a profession, your state's licensing board may require you to carry malpractice insurance, but nobody says you have to practice that profession in the first place. Of course, there are plenty of exceptions to the new individual mandate. If your taxable income is under the federal poverty line, or the cost of coverage is more than 8% of your household income, you don't have to pay the penalty. For purposes of this rule, family income is defined as total income in excess of the filing threshold, which is $10,000 for an individual and $20,000 for a family in 2013. If your taxable income is less than 4 times the federal poverty limit, you may qualify for subsidies to help pay for your coverage. The penalty is prorated by the number of months you go without coverage. So if you are without coverage for just half a year, you pay just half the penalty. There is no penalty for a gap in coverage that lasts less than 3 months. Finally, the penalty cannot be greater than the national average premium for bronze coverage on the exchange, which we'll discuss in a bit. So the individual mandate has been by far the most controversial part of the Obamacare legislation. But here's the weirdest part of the new law. There is no way for the government to enforce those penalties. In fact, here is what the Congressional Joint Committee on Taxation had to say in their explanation of the bill. The penalty is assessed through the code and accounted for as an additional amount of federal tax owed. However, it is not subject to the enforcement provisions of Subtitle F of the Code. The use of liens and seizures otherwise authorized for collection of taxes does not apply to the collection of this penalty. Non-compliance with the personal responsibility requirement to have health coverage is not subject to criminal or civil penalties under the code, and interest does not accrue for failure to pay such assessment in a timely manner. Right now, it looks like the worst the IRS can do is withhold your future tax refunds. Other than that, there's nothing they can do. No interest, no liens, no levies, no jail time, zip, nilch, nada. It will be interesting to see how hard the IRS works to enforce a penalty Congress says it's not even allowed to enforce. Who knows how many Americans actually pay if there is no real consequence for not doing it. Now let's walk through the new insurance exchanges and see how they are supposed to work. The goal of the health insurance exchanges is to establish a more organized and competitive market where consumers can learn about their options and compare standardized plans. Exchanges are intended primarily for individuals who don't have employer-based coverage, individuals whose income is too high to qualify for Medicaid, and small employers looking to buy coverage for their employees. States can establish their own exchanges, partner with the federal government to run their exchanges, merge their exchange with other states, or default into the federal mega exchange. As of May 2013, 16 states and the District of Columbia had announced they would establish their own exchange. 7 announced plans for partnership exchange, and 27 plan to default to the federal exchange. The exchange itself can be a government agency or nonprofit organization. Its main function will be to provide a website where consumers can compare the different plans. The idea here is that making it easier for consumers to compare plans will enforce insurance companies to be more competitive. If you've ever bought plane tickets on sites like Travelocity or Expedia that lays out different airlines' pricing and schedule side by side, then you will get the idea. Remember, starting in 2014, insurance companies cannot turn you down for pre-existing conditions. If you apply for coverage, you will qualify. That means there won't be any need for state high-risk HIPAA plans that cover people who are commercially uninsurable. The insurance exchanges will offer 4 levels of coverage: bronze, silver, gold, and platinum. There will also be a bare bones catastrophic-only plan for those under the age of 30. The bronze plan is designed to cover 60% of the average insured's healthcare costs. The silver plan is designed to cover 70%, the gold plan is designed to cover 80%, and finally, the platinum plan is designed to cover 90%. Each level will offer different premiums, copays, deductibles, and other out-of-pocket expenses. The law limits out-of-pocket expenses at any level to $63.50 for individuals and $12,700 for families. When premium rates first became available, it appeared that for the most part they would be lower than the Congressional Budget Office originally estimated. Generally, it looks like young health insureds would pay more than before implementing the new law, while other, sicker insureds would pay less. Of course, we have no idea what you might actually pay. The best answer there is just to look for yourself. Premiums will vary by age, just like they do now. And if you smoke, now might be a good time to quit, because premiums will be up to 50% higher for smokers. But the actual premiums may be less important than you think. That's because many people who end up buying coverage on the exchange will qualify for some federal subsidies. Federal subsidies are the flip side of the insurance exchanges. It doesn't do much good for Obamacare to lay out standardized plans for you to pick and choose from, or even guarantee you will qualify for coverage if you just plain cannot afford it. You will qualify for subsidies if you meet two conditions. First, your household income has to be less than 400% of the federal poverty level, or FPL. For 2013, the FPL is $23,550 for a family of 4, which means subsidies are available for incomes up to $94,200 a year. Household income includes income from you, your spouse, and any dependents. Second, if you have an employer who offers coverage, your share of the premium has to be more than 9.5% of your household income. So if your household income is $50,000 and your premium is more than $395 a month, you will qualify. The goal of the subsidy is to make sure you do not spend an unreasonably high percentage of your income on health insurance. So in some ways, it won't really matter how much the actual premium costs. If you are eligible for subsidies, you will only have to spend so much of your income on the coverage. The subsidies are based on the cost of the Silver plan. Your premium will vary according to where you live, of course, but the subsidies will always cap your premium at the appropriate percentage. The subsidy itself takes the form of a refundable tax credit. That means you can use the subsidy to offset your total tax bill at year end. If your subsidy is more than your tax, the IRS will send you a check for the difference. Ordinarily, this would mean filing your tax return for the year you pay for the coverage, then subtracting the subsidy from that year's tax, or waiting for the IRS to send you a refund. But most families just don't have the cash to wait around for a check. So the law lets you apply for the credit when you apply for the insurance, and the government will pay the subsidy directly to the insurance company. Of course, if your income at the end of the year turns out to be more than you said it would be when you applied, you can wind up paying back part of the subsidy, so you will want to be careful when you apply. You may have heard that the new law requires employers to offer health insurance or face some pretty hefty fines. That's not entirely true. The law wants employers to provide coverage, but it doesn't actually require them to provide anything. Instead, it imposes a backdoor penalty called the free rider penalty on certain employers who don't play ball. The law doesn't even apply to most employers. If you have 50 or fewer full-time equivalents, there's no requirement to provide coverage at all. To calculate the full-time equivalents, take the number of hours your employees work in a year and divide by 2,080. If you have more than 50 employees, then you generally have to cover employees working 30 or more hours a week. And you have to start coverage no later than 90 days after they start work. Otherwise, you will be subject to the free rider penalty, which we'll talk about in more detail later. Now let's talk about the nasty free rider penalty for employers with more than 50 employees. Remember, the Obama administration has pushed back the effective date to January 1st, 2015. This rule has gotten a lot of attention lately. You've probably heard many business owners threatening to cut employee hours or deliberately stay small to avoid these requirements. But it's worth noting that these new rules apply to just 4% of American employers, and 96% of that 4% already offers some form of health benefits to their employees. So, as an employer, you're subject to the penalty if you meet two conditions. First, you have to have more than 50 employees or full-time equivalents, FTEs. For purposes of this rule, 120 hours of work per month equals 1 FTE. You can't just hire a ton of 20-hour per week part-timers to game the system and avoid the penalties. Second, one or more of those employees receives a subsidy to buy insurance on their appropriate local exchange. That second condition surprises a lot of people. You don't automatically get hit with the penalty just by failing to offer coverage. Someone has to actually get the subsidy to buy insurance on their local exchange before the penalty applies. Now let's talk about calculating the penalty. If you don't offer any health insurance at all, and you meet the two conditions we just discussed, the penalty is $2,000 per employee after subtracting the first 30 employees. So if you have 51 FTEs and one of them receives a subsidy to buy coverage on their state exchange, your penalty will be $42,000 or $2,000 for each of the 21 employees after the first 30. If you do offer some sort of substandard coverage, but one or more employees still qualify for subsidies, the penalty is the lesser of $3,000 for each employee who gets subsidies or $2,000 per employee after the first 30. So you might actually come out ahead by providing lesser coverage even if one or more of your employees wind up getting subsidies on the exchange. It all depends on the cost of the coverage you provide. You will just have to run the numbers and see. Oh, and just because you'll ask, the penalty is non-deductible, so no, the IRS will not be interested in sharing your pain. Now that we've looked at all the new rules, let's tie it all together. What are your options if you're out there shopping for health insurance for yourself? Your first option is to simply do nothing. If you're comfortable taking the risk of living without insurance, there's nothing that says you have to go out and buy it. You will owe a tax penalty starting in 2014. But as we already discussed, the IRS has no statutory authority to enforce that penalty. It might turn out that all the controversy over the individual mandate amounts to nothing. If you already have coverage and you are happy with it, you can keep it. No need to worry about exchanges or minimum coverages or free rider penalties or anything else. Of course, your premiums will probably keep going up year after year, just like they do now. If you already have coverage and you are not happy with it, you can scrap it. You might find it's cheaper and easier to buy through one of the new exchanges. But now, you will have a way to compare coverage and benefits on an apple-to-apple basis with more information than you had before. You might also want to consider taking advantage of a Section 105 medical expense reimbursement plan or health savings account for help with out-of-pocket costs. We'll talk about those next. Obamacare focuses mainly on helping Americans afford insurance, but insurance rarely covers the cost of everything. Most of us still face out-of-pocket deductibles, co-pays, co-insurances, and other costs. What options do we have to help minimize those costs? One way to lower your costs is to make your healthcare expenses tax-deductible. If you pay for your own health insurance and you are self-employed, you can deduct your premiums as an adjustment to income on page 1 of Form 1040. If you're not self-employed, you can still deduct your premium along with the rest of your out-of-pocket costs on Schedule A. But that deduction only counts if it's more than 10% of your adjusted gross income, and most of us just don't spend that much of our income on healthcare. so we wind up with no real deduction. If you're self-employed, there might be a way to write off your insurance premiums along with your out-of-pocket costs as a business expense. It's called Medical Expense Reimbursement Plan, or Section 105 plan. This is an employee benefit plan, which means it requires an employee. If you operate your business as a sole proprietorship, partnership, LLC, or S corporation, you're considered self-employed. So if you're married, hire your spouse. If you're not married, you can do this with a C corporation. But you don't have to be incorporated. You can do it as a sole proprietor or LLC by hiring your spouse. You don't even have to pay your spouse a salary. You can compensate them in form of benefits only, which avoids the hassle of filing payroll tax returns. The only requirement here is that the benefits you pay be reasonable compensation for the services they perform. So if your spouse works an hour a month filing invoices for you, you will probably have a hard time convincing an auditor that there is reasonable compensation for a $4,000 worth of LASIK surgery. The main exception to hire your spouse rule is in the S corporation. If you own more than 2% of the stock, you and your spouse are both considered self-employed for purposes of this rule. You will need to use another source of income, not taxed as an S corporation, as the basis for this plan. Alternatively, you might consider setting up a health savings account or HSA, which we'll discuss shortly. Once the plan is in place, you can reimburse your employee for any medical expense they incur for themselves, their spouse, and their employees. One big advantage of the MERP is that it works with any insurance company. You don't have to buy special coverage. You can use the MERP with insurance you buy on your own or insurance you buy through the exchange. If your spouse gets coverage from their employer, you can even set up a MERP in your business to cover whatever out-of-pocket expenses your spouse's insurance does not cover. Let's assume you're a sole proprietor with 2 kids, and you've hired your husband to work for your business. The plan lets you reimburse your husband, employee, for all medical and dental expenses he incurs for himself and his spouse, which brings you into the plan, and his dependents, your kids. This includes all the expenses you see listed here above: major medical insurance, long-term care coverage, Medicare and Medigap insurance premiums, co-pays, deductibles, and prescription, dental, vision, chiropractic care, braces for your kids' teeth, fertility treatments, and special schools for learning disabled children. It even covers non-prescription medication when they are prescribed by a physician, vitamins and herbal supplements, and medical supplies. The best part is, this is money you would spend anyway, whether you get a deduction or not. You're just moving it from some place on your return where you probably cannot deduct any of it to a place where you can. You will need a written plan document, which we can provide you. You will need to track your expenses under the plan, which we can also help with. But there is no special reporting required. You will report reimbursements as employee benefits on Schedule C or Form 1065 or Form 1120. You will save income tax and self-employment tax. There is no pre-funding required. You don't have to open a special account like with the health savings accounts or flex spending plans. You don't have to decide upfront how much you want to contribute to the plan, like you do with the flex spending accounts. And there is no use it or lose it rule. The MERP is really just an accounting device that lets you recategorize your family medical bills as business expense. You do have to run the payments through your actual business. You can't just pay medical bills out of the family personal account, total them up at the end of the year, and throw them on the business tax return. This means you have 2 choices. You can pay healthcare providers directly out of the business account, or you can reimburse your employees for expenses they pay out of their personal funds. Let's say your husband needs to pick up a prescription. He can use his own money, or you can reimburse him. Or he can use the business credit card and charge it to the business directly. The MERP doesn't just let you save income tax. It also helps you save self-employment tax. Remember, when you work for yourself, you pay a special self-employment tax which replaces the Social Security and Medicare taxes that you and your employer would share on your salary on W-2. That self-employment tax is based on the net self-employment earnings. And when you set up a MERP, the deduction reduces that self-employment income. So here's the bad news. If you have non-family employees, you have to include them too. Now you can exclude employees under the age of 25 who work less than 35 hours per week, less than 9 months per year, or who have worked for you less than 3 years. But still, having non-family employees may make it too expensive to reimburse everyone as generously as you would cover your own family. Obamacare also imposes a pesky new excise tax requirement on MERPs called the Patient-Centered Outcomes Research Trust Fund Fee, or PCORI fee. For plans operating in 2012, that meant a $1 per person tax, reported on IRS Form 720 and due by July 31st. Yes, you heard that right. $1. You can't even buy a pack of gum for that much. But the statutory penalty for failing to file that report can be as high as $10,000. And while it's not likely that the IRS will ever actually impose that fine, you still want to make sure that you do dot your I's and cross your T's. And don't laugh at the $1 fee. The plans operating for 2013, the tax doubles all the way up to $2 per person. If a medical expense reimbursement plan isn't appropriate, either because you don't have a spouse to hire or you have non-family employees you would have to cover, consider establishing a health savings account. These arrangements combine a high-deductible plan with a tax-free savings account to cover unreimbursed costs. To qualify, you will need to be covered by a high-deductible health plan. This means the deductible is at least $1,250 for single coverage or $2,500 for a family coverage. Neither you nor your spouse can be covered by a non-high deductible health plan or Medicare. The plan cannot provide any benefit other than certain preventative tax benefits until you satisfy the annual deductible. You are not eligible if you are covered by a separate plan or rider offering prescription drug benefits before the minimum annual deductible is satisfied. Once you've established your eligibility, you can open a deductible health savings account to cover out-of-pocket expenses not covered by your insurance. You can probably do it at your local bank or any brokerage firm. You can contribute up to $32.50 for singles or $64.50 for families. You can use it for most kinds of health insurance, including COBRA continuation and long-term care premiums. You can also use it for the same sort of expenses as a Section 105 plan. The health savings account is not quite as powerful or flexible as the Section 105 plan. You've got specific dollar limits on what you can contribute to the account, which might not match your out-of-pocket costs. And there is no self-employment tax advantage as there is with the MERP. But health savings accounts can still help you cut the overall healthcare costs by giving you bigger tax deductions. Now that we've looked at options for individuals, what are your options if you're an employer? We'll start by discussing your options if you have 50 or fewer employees. Your first option is to do nothing. That may be what you're already doing. And if it's working for you, that's fine. If your employees are content buying their own insurance on the private market or relying on their spouse's coverage or even going without coverage, that's fine. In fact, they might be even delighted when they see all the new choices and the new subsidies available starting in 2014. Most employees don't know anything about buying health insurance, and they will find that starting next year, a little education really goes a long, long way. The problem with doing nothing, of course, is that in most industries, as employers get bigger, your employees come to expect some sort of health plan. It all dates back to World War II, when wage and price controls limited how much employers could pay their employees. To get around these rules, employers started offering healthcare benefits in addition to salary, and that led to our current employer-based healthcare system. If you currently offer your employees group health insurance and the plan that you have is working for you, you can keep it. No need to worry about exchanges or minimum coverages or free rider penalties. Of course, your premiums will probably keep going up year after year, just like they do now. And if you require your employees to pay part of the premium, don't be surprised if some of them hop off your plan and join the exchange plan. That's fine. You won't have to worry about paying for the cost of their claims anymore, and there won't be any legal consequences for their decision. Of course, if your plan participation drops below a certain level, your current insurance company may drop your coverage, but that's a different problem. If you already have a plan and you are not happy with it, you can scrap it. You may find it cheaper and easier to cut your employees loose and let them find coverage on their own. You can still cover part or all of their premiums and out-of-pocket costs. You will just do it with a Section 105 plan instead of a group insurance policy. Let's take a step back here and look at the big picture. There are thousands of employers across the country who understand their employees expect them to provide health benefits. But those employers don't want to take the risk of big claims. So they transfer that risk to an insurance company. That's the whole point of insurance after all. So they go out and buy a group insurance policy. And now they find that they are in the group insurance business. They are stuck deciding what benefits to offer employees, choosing coverage from a confusing selection of contracts, guesstimating how much they will wind up paying for higher premiums every year, and even dealing with teeth of employees when an insurance reimbursement gets stuck in red tape and a doctor sends a bill to collections. Who really wants that headache? The Obamacare rules will probably inspire a lot of employers to drop group coverage altogether and let employees pick the coverage that suits them. One strategy might be for employees to go out and buy subsidized coverage on their own state exchanges, probably for less than they're contributing now for their group coverage. Employers can then use a Section 125 premium-only plan to eliminate tax on those premiums. Then, employers can establish a Medicare expense reimbursement plan to cover the difference between the coverage their employees buy on the exchange and the old group health plan. This lets employers benefit by shifting the cost of covering their employees to the government, while employees keep the same level of benefits they enjoyed before the change. Your lower-paid employees might even want to consider taking advantage of Medicaid and so-called CHIP plans to cut their own costs. So now let's talk about how that might work. Medicaid and state children's health insurance plans, or CHIP plans, are currently the main source of healthcare coverage for lower-income working families. But the new Obamacare rules let employers take advantage of those programs to help finance coverage for their own employees. Employees are eligible for Medicaid if they are under the age of 65 and their income is below 138% of the federal poverty level. In 2013, that means $15,856 for an individual or $32,499 for a family of 4. Why would an employee choose to go on Medicaid or a CHIP program? Well, because it's free, and it stretches their employee reimbursement dollar if they don't have to use it for basic coverage. Let's say you're a business owner and you've terminated your group health plan. You have an employee with a child who makes $24,000 a year. She can certainly go out and buy coverage on her state exchange, But even after getting a subsidy, she will probably pay at least some premium. And she will still have out-of-pocket expenses to cover for herself and her child. Or she could enroll in Medicaid and enroll her child in the CHIP program. Now she will get all her basic coverage that otherwise might have cost her something, now for free. Now she can use any employer reimbursement for the inevitable out-of-pocket expenses that even the insurance exchange would not cover. Finally, what are the options for employers with more than 50 employees? Remember, these rules don't kick in until 2015, but it's still important to understand them now so you can anticipate your future moves. Your first option, again, is simply to do nothing. If you don't currently have a plan, doing nothing and paying the penalty may actually be cheaper than establishing your own plan. Your employees may resent you for it, but that's your decision to make. And if you do nothing, your employees can still find coverage on their own through the local exchange. They may even be happier with the coverage they find on their own than with the coverage you could afford to buy them. There probably won't be any shortage of big employers who grumble and pay the penalty rather than offer a benefit they just cannot afford. If you already offer your employees a plan, you can keep it if it's a good enough plan to protect you from the penalties, or you can modify it to protect yourself if it's not. To protect yourself, you need to make sure your plan meets the two requirements. These are the safe harbors that will protect you from the free rider penalty. First of all, you have to offer qualified coverage. That means it's equivalent to the bronze level coverage you would get from your local insurance exchange. Second of all, you have to make sure your employees don't pay more than 9.5% of their income towards the premiums. So for example, if your lowest paid employee makes $20,000 a year and your required monthly employee contribution is $158 or less, you're safe. If you meet both of those requirements, you will avoid the penalty. Even if an employee buys coverage through the exchange, they won't qualify for subsidies. And remember, the penalty isn't triggered until an employee gets subsidies to buy coverage on the exchange. It's worth mentioning that starting in 2014, businesses with up to 100 employees are welcome to buy coverage on the local Small Business Health Option Program, or SHOP exchange. Beginning in 2017, states can choose to allow larger employers to participate as well. Many companies above a certain size, typically 500 or more employees, choose to self-insure their employees or self-fund their plans. That is, they look to save money by cutting out the insurance company middleman and pay benefits and claims directly out of their own pocket. That's usually some insurance involved. Typically, self-funded plans still have a stop-loss policy to limit their risk to, let's say, $50,000 or $100,000 per employee in case of a really bleak claim, just like cancers or birth defects. They usually rent an insurance company's network to administer the paperwork and manage claims on behalf of employees. But the concept here is pretty straightforward, paying benefits themselves instead of through an insurance company. Companies that self-insure do it because their size make it cheaper to take the risk themselves than paying an insurance company to take it. But self-insured companies can still benefit from Obamacare by using the new rules to lower their risk of claims. And that's an important benefit. Let's say you run a manufacturing company with 500 employees. You've chosen to self-insure up to $100,000 per employee. That leaves you with a theoretical risk of up to $50 million in claim. Now, we know not everyone has and will cost that much, but you might still have 6 employees with cancers, birth defects, or other expensive conditions costing $100,000 in a year, plus all the rest of your 500 employees' claims. Why not cut those 6 employees loose from your own plan, send them to their local exchange, where they cannot be denied coverage, and set up a Section 105 plan to cover the same benefit they would enjoy under your own plan. That would send $600,000, minus the cost of buying their coverage on the exchange, straight to your own bottom line. As long as they don't qualify for subsidies, you will be safe from the free rider penalty. What business wouldn't want to eliminate that sort of a risk? In fact, if the numbers work, why not cut all of your employees loose from your self-funded group plan and send them out on their own? Now you will cut your risk by millions and save even more when you don't have to hire an HR staff to manage the plan. If you feel guilty asking employees to go out and choose their own coverage, you can keep a staffer or two to help them make sense of the coverage. But again, you might find your employees would rather find their own coverage than sell for whatever doctors, hospitals, pharmacies, and benefits you pick for them. Now let's talk about some of the new taxes we all face under the Obamacare rules, whether we are wealthy or not. Specifically, I'm talking about the new Medicare surtax and unearned income Medicare contribution. These are not tied to any specific benefit under the law. They are just designed to raise general revenue to help pay for the new law. You already pay a Medicare tax on all your earned income from salaries and wages and business income. If you're paid as an employee, your employer pays an amount equal to 1.45% of your gross earnings, including anything you contribute to a retirement account, and withholds another 1.45% directly from your pay. If you're self-employed, you pay self-employment tax of 2.9% on your net self-employment income. The new Obamacare rules add 0.9% surtax on earned income above $200,000 for individuals and $250,000 for joint filers. That might not sound like a lot, but it's $900 in new tax for every additional $100,000 in income, and it will add up fast. And there is really not much you can do other than not earn the income. If you're self-employed, you might consider restructuring part of your business to recategorize some of your profits as passive income. However, that's not always a realistic option. There's also a new 3.8% unearned income Medicare contribution on net investment income. Doesn't unearned income Medicare contribution sound so much better than tax? Aren't you going to be so much happier paying an unearned income Medicare contribution than you would be paying another tax? The new tax law applies on net investment income, which the law defines to include interest, dividends, capital gains, rents, royalties, and taxable withdrawals from annuities. It kicks in at the same levels as the Medicare surtax, $200,000 for individuals and $250,000 for joint filers. If you file as single and you have $210,000 of earned income plus $10,000 in investment income, you will pay the 0.9% surtax on your last $10,000 of earned income and the 3.8% tax on $10,000 of investment income. Avoiding at least some of the 3.8% unearned income Medicare contribution may not be as hard as you think. It's really a matter of choosing tax-efficient investments. The same strategies that help you pay less regular tax on your investment income in the first place will also help you avoid the Medicare tax. Your first line of defense is choosing investments that don't generate taxable income. If you are investing for income, for example, bank account interest and most bond interest is fully taxable. That means they are subject to regular tax plus the new Medicare tax. But for example, municipal bonds are free from federal and most state tax income. So shifting fixed income portion of your overall portfolio will help defeat the Medicare tax. If you are investing for retirement, you can choose to wrap your investments in tax-deferred wrappers like IRAs, Roth IRAs, and qualified retirement plans. Avoiding the new tax on capital gains may be harder. If circumstances make now the right time to sell an appreciated asset, whether it's a stock, mutual fund, or real estate, or even your business, then you shouldn't let the tax consequence scare you out of making the right investment move. But you might look at strategies like matching capital gains and losses. For example, if it's the time to sell a stock and you've got a $10,000 gain, is there another stock with a $10,000 loss you can sell to offset that gain? There is one especially irresponsible rumor going around about this new tax, and I want to address it head on. Specifically, I'm talking about the rumor that Obamacare imposes a 3.8% tax on selling your house. Let's say you're a single person and you bought your home 20 years ago for $125,000. You've added $50,000 in improvements, and now you're selling it for $475,000 after commissions, closing costs, and other selling costs. If the rumor is correct, when you walk away from the closing with your cash, you will owe Uncle Sam 3.8% of that amount, or $18,050. The reality is a lot less harsh. You may owe a tax, but you will just start with the $475,000. Then you will subtract your original basis in the house, in this case, the $125,000 you paid 20 years ago. Then you will subtract the $50,000 you paid in improvements, and that leaves you with $300,000 gain. But then you will subtract your Section 121 exclusion, in this case, $250,000. And if you were married filing jointly, that exclusion would be $500,000. That leaves you with a $50,000 gain. If your other income puts you above the $200,000 threshold, you will owe the Medicare tax, but it will be just 3.8% of the $50,000 gain, or $1,900. Paying a $1,900 tax on your gain won't be fun, but it's a lot easier than paying 3.8% on the $475,000 gross sales price. Now that we've talked about the specific provisions of the new law, let's talk about how it's all going to work. If you like government red tape, you will love Obamacare. The law has over 500 specific provisions with almost 50 major changes to the tax code. The Treasury Inspector General for Tax Administration says tax provisions included in the Affordable Care Act represent the largest set of tax law changes the IRS has to implement in more than 20 years. The actual text of the two bills that make up Obamacare run over 2,500 pages. Future regulations will run tens of thousands more pages. For example, on February 20, 2013, the Department of Health and Human Services released a final rule establishing the minimal essential health benefit for plans sold by the new insurance exchanges, and that ran 149 pages all by itself. One first draft of the application form consumers would use to apply for the insurance subsidies ran 21 pages. As for enforcement, there will be lots of people with their finger in the pie, but two agencies will be the most important. The Department of Health and Human Services will be primarily responsible for the healthcare provisions of the law. They will issue regulations, promulgate standards, and generally do the sort of things you would expect HHS to do with a law this sweeping. The IRS will collect information from employers and insurance companies, figure out who qualifies for subsidies and Medicare coverage, determine who owes penalties, and penalize employers who don't play ball. The IRS has already created 8 new offices with over 2,100 employees to enforce the new law, and the Obama administration has requested $440 million in new funding to pay for it all. That's a lot of work for both agencies. It's probably not being cynical to say we should expect a fair amount of hiccups along the way. You would think that 3 years after passage, Obama opponents would move on to new fights. Well, you would be wrong. The opposition isn't folding, even though the Supreme Court has upheld the law as constitutional. Many congressional Republicans continue to vote to overturn Obamacare in full. They don't have the votes to do it, at least not in the Senate, and they certainly aren't going to get the support they would need to override a presidential veto, even if they do overturn it. But opponents, especially in the House of Representatives, still have enough clout to make political hay. In fact, on May 15th, the House voted for the 37th time to repeal Obamacare, just to give 71st-term representative a chance to go on record as opposing the law. So where do we go from here? There is no doubt that what we've seen is just the tip of the whole iceberg. The way that we Americans pay for healthcare is changing. You might think it's a good thing, or you might think it's a bad thing. You might think Obamacare is godsend, or you might think it's a slow-motion train wreck. But Obamacare is the law of the land. Congress passed it, the president signed it, and the Supreme Court upheld it. So despite of the best efforts of political opponents trying to repeal it, it's probably here to stay. And let's make sure we all pay attention to the rules as they develop. I also want to point out how important it is to get the right advice about all this. None of us know everything about Obamacare. Be especially careful when you get advice from someone with a vested financial interest in your specific decision. Most so-called benefit consultants don't actually consult on anything. They sell health insurance. They know all about health insurance policies and health insurance benefits, but they don't get paid until you buy something. And when you do buy, they get commissions and bonuses that go up the more you spend. They may not even have to disclose how much they get paid. So while they might say their commission is a flat X dollars per head, regardless of coverage, they may be on the receiving end of a fed bonus that's even more than the base commission. And they have no financial interest in solving problems if the right solution means lower commissions. In fact, the exact opposite is true. This doesn't mean that you cannot trust your agent, but just like you wouldn't buy a used car without getting it to the mechanic or at least looking under the hood, you shouldn't take advice about important decisions like healthcare without knowing what's at stake for your advisor. So that concludes our presentation about Obamacare. Please call us with your questions. If we can't answer you right away, we'll find the answer for you. My information is on the screen. If you want to know more about the medical expense reimbursement plan, or how you can set one up for your business, or if you qualify, please don't hesitate to contact me. Thank you again for listening. I'm looking forward to hearing from you soon.